July 2, 1997. Thailand's central bank floated the baht, supposed to save the economy. It destroyed the entire region instead. Within weeks, 4 currencies collapsed, billions fled, governments fell. But one leader rejected every expert and made a radical bet that worked. I'm David. This is the story of how the people trying to save Asia might have made it worse. In 1995, Bangkok was under construction. Cranes filled the skyline. New office towers were rising, shopping malls sprawling, highways expanding. Thailand's economy was booming. Indonesia, South Korea, Malaysia, same story. The money wouldn't stop coming. Foreign investors were pouring billions into Asia, and the reason they felt safe doing it was one simple thing. Every tiger economy had pegged its currency to the US dollar. The baht, the rupiah, the won, the ringgit. All locked in place, rock solid, no currency risk. Here's the trap. Corporations inside those countries borrowed in dollars and earned in local money. But the peg promised those two would track forever. So investors thought, why worry? The exchange rate can't move. The money poured in. That peg became the reason trillions kept flowing in. And it would soon become the reason everything collapsed. Because by 1996, something had started to strain beneath the surface, and the very thing that attracted all that capital was about to become the mechanism that turned prosperity into the worst financial crisis in decades. All that money flowing in looked like prosperity. But inside Thailand, cracks were opening. The country was importing far more than it was exporting. Thailand's current account deficit was swelling in 1996, but instead of slowing borrowing, Thai companies accelerated it. They borrowed in dollars from foreign banks, betting the peg would hold. This was the hidden mismatch. A Thai company would borrow $10 million from a New York bank, convert it to baht at the pegged rate, then build a factory or invest in equities. Revenues came in baht. Debt was in dollars. As long as the peg held, the math worked. 10 million stayed, 10 million. But the peg was structurally impossible to defend. Thailand's forex reserves were finite, and they were draining fast because of that current account deficit. Nobody was asking the right question: what happens when we can't defend the peg anymore? The answer was locked in, waiting. The debt was real. The income couldn't change. Only the peg could break, and when it did, that currency mismatch would metastasize into a debt explosion. On July 2, 1997, after months of burning through foreign exchange reserves to defend a doomed peg, the Bank of Thailand capitulated. They announced the baht would float, no more fixed rate. The currency would find its own level, the market would decide. Officials called it a technical adjustment. It was the sound of the trap snapping shut. Within days, the baht lost 20% of its value. That 10 million Thai company owed, it was suddenly worth $12.5 million in baht terms. But revenues hadn't changed. Interest payments jumped. Factories became uneconomic. Bankruptcy filings piled up. But the real damage wasn't contained to Thailand. The moment the baht broke, investors across Southeast Asia asked one question: if Thailand's peg was broken, which other peg might break next? The answer was all of them. And the money began fleeing. The money fled faster than any central bank could stop it. Speculators saw the crack in Thailand and attacked every pegged currency in the region. By late July, the Indonesian rupiah was weakening. In August, South Korea's won collapsed. Malaysia's ringgit followed. Each currency that broke triggered the next. Investors watched one peg fail and thought ours could be next, so they pulled their money out before it happened. Within 3 weeks, trillions in capital had reversed direction, no longer flowing in, now flowing out. Manila, Jakarta, Seoul, Bangkok, Hong Kong. The same markets that have been soaking up foreign money were now hemorrhaging it. Here's what the peg had done. It promised that exchange rates were stable, so it sucked in trillions of unhedged debt. When one peg broke, the market realized every peg was just a bet, one that was about to lose. It wasn't a contained crisis, it was a domino cascade across an entire region. And the contagion was only halfway done. Because as currencies crashed and capital fled, the real question opened up: who would stop the bleeding? The answer would define how fast this crisis turned into catastrophe. As central banks burned through their last foreign exchange reserves, four leaders faced the same crisis with completely different plans. Mikhail Kondessis ran the International Monetary Fund from Geneva. Mahathir led Malaysia. Suharto controlled Indonesia. Kim Dae-jung had just taken office in South Korea. Kondessis believed in discipline. When a crisis hits, you impose austerity, close your borders, restructure your banking sector. Short-term pain for long-term gain. It was the playbook the IMF had used everywhere. Latin America, Russia, Africa, and Kondessis was ready to impose it on Asia. Mahathir disagreed completely. He believed that opening your capital account had been the mistake, not the solution. And once the crisis hit, you didn't surrender to an international institution. You took control back. You imposed capital controls. You pegged your currency. You charted your own course. Suharto and Kim would have to choose between these visions, but they were running out of time fast. The forex reserves were draining. The currency pressure was becoming unbearable, and the IMF was waiting with its checkbook and strict conditions attached. The IMF moved fast. By autumn 1997, Indonesia and South Korea had signed bailout agreements. The conditions were clear: cut government spending, raise interest rates, close weak banks. The idea was brutal but logical. Starve the fire of fuel. If companies couldn't borrow, they'd stop overextending. If banks failed, the weak ones would die and the strong would survive. Austerity now, recovery later. Except that wasn't what Asia needed. The region had a liquidity crisis, not a solvency crisis. Companies weren't fundamentally broken. They just couldn't borrow because capital had fled. The IMF's prescription made everything worse. Raising interest rates made borrowing even more expensive, so solvent companies went bankrupt instead. Closing banks forced depositors to panic. Cutting government spending meant hospitals cut supplies, universities cut programs, jobs vanished. Within months, unemployment spiked. Protests filled the streets of Jakarta and Seoul. Families couldn't afford food. Suharto's 32-year regime began to lose control. The IMF had deepened the contraction and turned an economic crisis into a political one. By 1998, the region was in free fall. Indonesia's economy contracted sharply. Suharto, who'd run Indonesia since 1966, was forced out of power. Riots burned through Jakarta. The political order had collapsed. South Korea went through a different kind of rupture. The government began dismantling the cable, the massive conglomerate families like Hyundai and Samsung that had been the spine of South Korean growth. Forced restructuring meant mass layoffs, factory closures, bankruptcy filings. The cable survived, but hollowed out. Thailand and Malaysia each faced their own cascades. Property values crashed, construction stopped, unemployment surged. The foreign investors who'd poured in trillions just years earlier pulled out everything they could. For all five economies, Indonesia, Thailand, South Korea, Malaysia, and the Philippines, 1998 was a year of rupture they'd feel for generations. Asset values had collapsed. Capital flight continued. Forex reserves that had taken decades to build were depleted. The very currency pegs that were supposed to protect regional stability had amplified the shock instead. One lesson seemed clear: fixed pegs were a trap. But there was a complication. One leader had rejected the whole IMF playbook and chosen a completely different path. And his gamble was about to reveal something the consensus had missed. In September 1998, Mahathir made the move that broke every rule the IMF had written. Malaysia would peg the ringgit. Not defend an old peg like Thailand had failed to do, but impose a new peg, fixing the ringgit at 3.8 to the dollar. Mahathir also imposed capital controls. Foreigners could get money in and out only at controlled rates. The international consensus called it madness. Economists said capital controls didn't work. Pegging a currency in crisis was suicidal. The IMF was critical. But Mahathir read the moment differently. Malaysia needed stability, not discipline. Investors had panicked not because Malaysia was broken, but because Contagion was driving irrational capital flight. Lock in the ringgit. Stop the bleeding. Break the panic. It was an unconventional bet. Malaysia stabilized, while Indonesia and Thailand, following IMF austerity, continued spiraling downward. Mahathir's heterodox gamble succeeded where consensus policy failed. It raised a question that would haunt policymakers for decades. Had the IMF imposed the wrong cure? In the years that followed, the two paths diverged starkly. Malaysia emerged from the crisis and resumed growth within 3 years. Unemployment fell, confidence returned, capital slowly came back. Mahathir's bet on unorthodox policy had paid off. Meanwhile, Indonesia and Thailand limped forward for years. Unemployment stayed high, growth stayed depressed, the IMF bailout cycle dragged on and on. The policymakers of the region learned something that wasn't supposed to be in the textbook. Maybe the IMF had been wrong. This verdict shaped everything that came next. Over the following 25 years, every Asian central bank became obsessed with one thing: building up massive forex reserves. Not to defend fixed pegs, the crisis had killed that idea, but as self-insurance. They'd learned that when capital fled, you needed your own money to stabilize your own currency. You couldn't rely on an IMF bailout that came with conditions you couldn't control. They also shifted to more flexible exchange rates so they could absorb currency swings without burning reserves. The old peg system was dead. In its place, floating rates, massive reserve buffers, and a deep skepticism of letting a foreign institution control your crisis response. One lesson the region never forgot: when the trap snaps, the first instinct to fix it might be backwards. Today, 28 years later, the same trap is springing again in the Philippines and Indonesia. Manila is facing a 26 billion foreign exchange crisis. The Philippines has run a huge current account deficit, just like Thailand did in 1996. The peso is weakening, foreign capital is fleeing. The institutions are the same: central bank burning reserves, local companies in debt spirals, pressure mounting. In Jakarta, the same dynamics are playing out: capital hemorrhage, currency pressure, central bank reserves dwindling. It's not 1997. The scale is different. Institutions more robust. The IMF knows better. Central bankers more cautious. But the mechanism is identical: pegged or quasi-pegged exchange rates that mask unhedged foreign debt until the moment they can't. The irony is brutal. The region learned the lesson in 1998. Central banks built massive reserves, floated currencies, vowed never again. Yet, corporations and investors everywhere still get seduced by the same trap: borrow in dollars, earn in local money, assume the exchange rate won't move. The policymakers of 2026 aren't making 1997's mistake, but the borrowers are. And that's why the cycle keeps repeating. The lesson gets learned at the top, but never taught to the people holding the debt. The trap was never fixed. It just moved to different countries. Policymakers learned in 1998. Borrowers didn't. I'm David. Like and subscribe for the next financial crisis before the news covers it. See you tomorrow.